So look at it on a weekly. This is what it looks like on a weekly chart. You can see that pin bar already right there. And basically, we should see that fall from that level, because what gold has done so far, it's broken. Let me get this. It's broken above this level. Gold has always consolidated around this range for a long time. It's 1367 was the maximum it's ever been, and then it broke out. But as soon as it broke out, there was not really a retest. It almost did a retest right here. There's no retest, so there's a likelihood that price might do a retest this year. So for maybe 3,000 pips, I don't know. It's a possibility. There could be that retest in the play, and then we can buy it back up. But what I want to show you guys is this. So this move, I've been capitalizing on this move since 2017, and this is one of the things that got me a big account as we went along trading, because I've been trading with a few of my friends since 2017 when I started using this tool. So this move happens most of the time. See this drop? What date is this? Yeah, this drop on the 4th of April, 11th of April.
Sorry, we can't see your screen. We're still seeing the chart.
Oh my days. All right, what about now?
Yeah, you can see now.
All right, perfect. So see this drop, right, on the seasonal. Gold normally does this. So the move that we saw, the up move we saw last year was this, right? This December move. So it's completed this December move. It did this move, the September move. It did a bit of it. And what we're on that highest phase, which gold gets to, and then it's going to drop all the way to somewhere around July or end of July. So mid-July, early July, or end of July. So that's the move we're capitalizing on now. I mean, it's not a straightforward move, but it's going to be a kind of a rocky one. But ultimately, what we should see is gold drop all the way down to probably around this level or this level, or maybe here, minimum around this level, here or here. Now, I would ideally want to see gold get here to retest where it broke out from, and that's about 3,000 pips. It might not happen. That might be wishful thinking. If everything goes down from coronavirus and everything goes all the way down, and because UK is getting lesser debts now, so and some other country are getting lesser debts, except from Africa will be the one hit the most right now. What we should then see is gold drop down. Then we can all capitalize on this move. I mean, we can all just focus on this move and forget the rest of the Forex pairs and focus on this move and sell that down and use the rest of the money being made to buy, pairs
Stocks.
and stocks. Yeah, exactly. Like, airline stocks mainly, just to buy those up, or any company that you feel that is going to be working at this, that's been affected majorly.
Majorly airlines.
Yeah, airlines are the ones I'm going to go for it. So, we're going to buy those back up. So ideally what I want to see is this come down following the seasonal move. And then in July, we're going to end up buying it back up. And then in September, we're going to sell it back down. So what we want to do is we want to do a 3-phase move. We want to sell. If price gets here, we want to buy. Then when price goes higher, we want to sell again. So altogether, we could take maybe 10,000 pips from just one trade. There's a high possibility we can get about 10,000 pips from that. And even if you go in with 0.10, that would generate you 10 grand from now all the way to, if we then take the up move as well, so let's say about 13,000 pips. So if we did that from now all the way to January next year, you should be able to generate at least 13,000, pounds or dollars if you're just using 0.10. But if you use one lot, that'll be 130,000. Or if you want to go crazy 10 lot, that's 1.3 million. So it depends on you. But in this space, we can actually expect this move to happen. So this down move followed by an up move, followed by a down move, then a final up move. The good thing is we know the season, how it does its stuff. So it's now about getting the proper entry. So that's why I want to speak today about technicals. Right. So one thing we have to understand is regardless, even if we have everything on point, we have the key when it's going to go up and go down and all of that stuff. If we don't get our technicals right on entry, you will still not profit from this trade. That's just a fact. So what we need to do now is try to work out our entry. Now, when I say we work out on our entry, I'm kind of not using indicators at the moment. I'm just using my own eyes and my own intuition to trade. So this is how I go about it. And I'm trying to develop a new way that's going to create like a good understanding for everybody. So first things first, always start from a higher time frame. Monthly, I would suggest monthly. Understand? Monthly will be the best option for you right now, because from now all the way to December, I would suggest we just focus on gold. Our prime focus should just be on gold right now. If we capitalize on this trade only and you study it properly, you'll be able to make a killing. We're not talking about small money right here. We're talking about making a killing in the market, just focusing on this alone. Because of the volatility, there's the volatility there, the liquidity is there, and the money is there. The only thing you need, we have the strategy as well. The only thing you need is get the right entry and the right exits. Those are the only two things you need. Get the right entry, get the right exit, and make sure you avoid consolidation at all cost. So in my own small research over the week, what I've figured out is this. Wherever you see wicks, like price wicks like this, I like that zone. You know, you see this wick right here? I'm going to take this wick. Ideally, I don't want to take this because I know price is not going to get there. But if you look at this wick right here and look at this wick, it's all in the same range. You can ignore this body of the candle. This is just a fake out right here, making people thinking price is breaking out, going higher. But it's a fake out. Ideally, the candle will have ended somewhere around here. All of this is just noise. So what you want to do is I like the segment of the wicks. Then go on to a lower time frame. And this is what we normally do in my stuff. I always say, go for the tail, the bottom, right? So at this stage, when we look at price, we can see right here, price retested this bottom area right here. And it's also where the candle stopped right here. And also where the candle stops right here. Ideally, what I want to do is make my entry somewhere around here. So once I highlight where the wicks is, I would highlight where the edges are. So this part is one entry. This part is another entry. And please, if you have any questions, because I presume this is going to be a bit confusing. If you have any questions, just let me know. So I re-explain everything. So this would be ideally where I want to go in here or here. Now, what could happen is price could come in and test this area, then go back down. Or price could come very close to this area and go back down, or price could break through. Now, regardless of whatever happens, you have to be willing to have a set amount of loss you want to take. You understand? So you have to have a stop loss in mind. Now, having a stop loss in mind is not just going to be something you're going to be static about. It can be a dynamic stop loss based on the way the market move. And I always recommend using the ATR. And I know I've gone through this before, but if you're new, I always recommend the ATR. And if you've seen this before, please bear with me. So 14-day ATR, 40 candles ATR is best. Right here, we see 84 pips. And because it's gold, it's not 84. It's about 840 pips. 850 pips, actually. Just take the this part, the end. 850 pips. Now, I cannot put a stop loss of 850 pips in place. I'm not crazy. You understand? I don't want to blow my account. So what I would tend to do is I would personally, from here, from my first red line right here, I would say, okay, maybe the entire loss I want to take in this trade is £1,000, for example. I would figure out how many pips am I going to break that into. So £1,000 for me would be, let's say I trade with 0.10, hypothetically speaking. Then that would be a 1,000 pip stop loss. Okay, that would be a 1,000 pip stop loss, in which my stop loss is going to be somewhere around here. Now with a 1,000 pip stop loss, I don't have anything to worry about. If price comes and hit here and decide to go higher and maybe stop around here and start coming back down, I'm safe, right? The trick in this is not to get greedy. You don't want to grow your account very quickly. What you want to do is have a sustainable growth. So let's say, for example, you have a $1,000 account, and throughout this trade, all you want to risk is 50 pips. It's $50 or 50 pounds. I would recommend going in. I know this sounds crazy and it sounds stupid, but I recommend going in with 0.01. That's just it for me. I recommend going in with 0.01. The main reason being, if you go in with 0.01, if price pulls back up, it has to pull 500 pips in order to close you out. So somewhere around here before you get a closeout. Okay, so let's say this is what I was looking at. Let's now move there. Look, based on what we highlighted right here, remember step one is go into a bigger time frame and select where you see the wick. Step two is to go into a lower time frame, then look for the bottom end of the wick. You know how we normally do it, looking for resistance and support levels. Let's go for the tip and the tip. I found a tip right here. I found a tip right here. I couldn't use this because everything I have to look for, my resistance level has to be within this yellow box, and I couldn't find any resistance level. This is my first resistance, my second resistance, right? So I'm gonna take a trade once it gets here and set 100 pips or maybe 1,000 pips stop loss. Now 1,000 pips stop loss on 0.01. Okay, it's not crazy. It's gold that we're dealing with. The main reason we're getting stopped out is because we don't have an adequate stop loss. So in order to avoid that this time around, you have to have a big enough stop loss for a smaller entry size. You're not going to get your entry right 100% of the time. But what I figured out through last week is this strategy works a lot more better in gold. So look for the tip, look for the tip. And when price got to the first tip, price started dropping down, in which you set your stop loss. Let's say, for example, with that 0.10 that I did, and I'm risking 1,000, for example, my stop loss would have been somewhere above right here. So price didn't even get there. What I can then decide to do is maybe once price move 50 pips into my profit zone, then I sell another 0.01, put in another, 1,000 pip stop loss, or I just put maybe a smaller pip size stop loss, maybe back to my entry. I put my first trade at break even and I stretch the entry and the stop loss of my second position. Or if you want to be like tight and be a little bit like, I don't want to risk anything, set a trailing stop for your second position that once it's in profit, maybe 20 pips, it should lock it in. Now, if price locks it in at that point, what tends to happen is even if you get kicked out of that second entry, you will still have your first entry regardless. Now, let's say with your first entry, we're aiming for 2,000 pips with that 0.01. That's $2,000 or 2,000 pounds easily without having to worry about anything. As price moves lower, you can be compounding, but you can only compound on dates where you're sure of price moving down, like this. On the 29th will be your next compounding if you want to compound. On the 6th will be your next compounding if you want to compound. And on, let's see, where is it right here? Where all three align. On the 18th will be your next compounding if you need to compound. I hope I'm being clear. $200.
Yeah, you know.
Okay, yeah, thank you. What, you mean $200 stop loss, Mukhtar? Mukhtar, I don't quite understand your question.
I was saying $100.
Your signal broke a little bit. I don't understand, bro.
Network issues.
Yeah. If you can type it up so I can understand better, that would be great. So now let's say that's how to do, that's one way to approach the market. Now, we have to move away from the mentality of trading into investing. And especially since we're going to be trading stock once coronavirus goes out of the way, I would recommend investing mindset ASAP. You don't want to be trading. You want to be invested now. So what you want to have in your mind is how much profit do you want to make before you even go into the trade? How much do you want to make and you'll be satisfied with? That would determine your stop loss size, your entry size, and your entry level, your stop loss size, and your entry what's it called? What's that thing called? Lot size. Yeah, that'll determine your lot size and your stop loss size and your take profit side. If you know how much you're willing to take as a profit, you will know how much entry you need and how big of a stop loss you need, because based on how much you want to risk. You always have to know this. This is one thing you have to always know. How much do you want to make from this trade? If it's £1,000, if it's £10,000 or £20,000, just have that in mind. That will determine where your stop loss is and where your take profit should be. And for the guys that have this, there's an Excel sheet on the website which has the calculation done for you in the money management segment. I don't know if you guys have this. If you don't, you should download it. There's a spreadsheet right here that helps you with that stuff. So these are the stuff you need to keep in mind. Okay, you have to know where your entry, your exits are. Now let me break this even further down. Let's say now this week, for example, I'm still selling gold. All I'm doing, I'm going to be focusing on is gold. Now what I want to do is, in this situation right here, I can see that, like price has actually gone here, tested this first entry and gone down. So the next thing, ideally, what we normally do before is put maybe an entry right here, saying price will pull back and come back to this zone, right? Now that's correct. That's not wrong. Then again, what I would ideally want to do is I'll go to weekly time frame. Let me just delete. I'm gonna delete all this one. I don't think. Is there any question on the first yellow line and the red that I've drawn?
No.
Okay, so that's good. So what I'm gonna do now is I'm gonna go back and try to find a new entry for this week. So let's start this all over again. So I'm looking at the monthly, and now on the monthly, I see here as a potential, but because I can't find enough wicks, the wicks are above right here, and I don't think price will come back there. So I'm just going to leave that alone. But I still highlighted this zone right here as a potential entry. So what I'm going to do next is I'm going to go to weekly chart. Now, going back to weekly chart, all I want to do is find an area around here that has a lot of wicks. Just a whole lot of wicks. That's what I want to look for. Now, there's wicks above here, but I don't think price is going to get here, to be honest. But I think I can take the wicks below here. This wicks right here will be something for me to take. Right around here will be good. Now, the main reason I'm taking the wicks around here, let me even see, is because price kind of gave it a support right here. And look at this level, it became a resistance right here. So what I'm expecting to happen in this situation, let me see if I can draw this and draw this out, is, okay. Now I'm going very far back. In order to look for this money, you have to dig deep, man. You have to really dig deep. Market is crazy like that. So what I'm gonna do is this. Around here is my weekly zone. So I'm gonna come to daily. And what I'm expecting is this, right? If you look slightly, this one kind of just had a small wick right here. So it's not sufficient enough, but if we look at it on smaller time frame, it might be big enough. But what I'm looking for is price coming back maybe somewhere around here, around this red zone right here. So price retesting something. So probably doing like a, we can't call it head and shoulders because it's not fully formed yet. But price, what I'm expecting price to do is probably pull back up, test somewhere around this area where this wick is and the zone is. Maximum level is here, where this yellow line is. And if we look at that, that's about 199 pips. So if I want to take this trade, for example, and I'm saying I'm going to be patient, no matter what happens, do not look at a smaller time frame. Just don't even bother, because in gold, it's going to trick you and make you think price is going down. Price is not going down. It will come back up and raid you. So just stick to your higher time frame. Daily time frame is the best. If you can use 4 hours, use 4 hours, but don't go anything below an hour. There's no point. So what I would expect to do around this area is let price come back somewhere around here. Now, if price comes back to this red line, I might take a short position. Now, when you're looking at it right here, you would be like, why would I take it? It doesn't look like a resistance point. I saw this resistance point from the monthly candle. This resistance point came from the monthly candle. So on a daily candle or on a 4-hour candle, it doesn't make any sense. The only time it makes sense is here, around here. So, I mean, if we drew right here, I'm going to confuse you guys a little bit. I just saw something on the 4-hour time frame. So let me just, my first entry zone will be somewhere around here. Now, ideally, it doesn't make any sense. You'd be like, why would I choose this zone? It doesn't make any sense on the 4 hours. I saw that on the monthly. That's why this would be my first entry. Now, let's say, for example, the market gapped to the downside. Market gapped down here when it opened, right? Like something like this when market gaps like this or gaps like this. You know what I'm saying? So let's say it gapped to the downside and you'd be like, oh, damn, price is gone. And you're thinking price won't get here. The next entry zone could be your 4 hours right here. So this top side right here, always look for the wicks first. The wicks is very necessary. You can see right here as well, the wick actually played a lot of impact right here. Wicks everywhere. And even all the way to down here will be the wicks. So what I would expect is if price does that, we'll use this wicks that we've seen here plus the resistance level right here. I wouldn't go for the first wick on the downside right here. I'll go for this side right here. If price gaps to the downside, then ideally I expect price to pull back up here before it starts going back down. Have I confused anybody? You guys sure I'm not confusing you?
Yeah, you're not.
It makes sense to me so far. I understand.
Okay. So if that's the case, that's perfect then. So that would be my next entry point. Now, let's say I don't have the mind to hold the trade for too long and, because of the pullbacks and all of that stuff, I would ideally want to take my first profit where I see the wicks. Same ideology. What's happening there? You can see massive amount of wicks right here, massive amount of wicks around this level. You have to look at it. It's always a level. It's not going to be just one price zone. It's always going to be a level. So this entire segment right here, let me see if I can, I'm trying to get the top of this, but it doesn't really matter. So what we're seeing right here is a level. Now, from this level, I want to take my profit anywhere around here. So the first thing I'm going to look for is where does it seems like the body of the candle ends here, the wicks end somewhere around here, but this wick right here, this one wick right here gives me a very good, nice level. This tiny one gives me a good, nice level of everything else. So if I want to take my profit, I'll first take my first profit around here. So if I entered from there, I'll take my first profit at 209 take profit. This is if I'm not brave enough and I just want to take my profit as I'm going along. I'll take this 209 pips, and that's perfect for me or anybody else. I mean, if you're trading this aggressively, maybe with 2 lots, if I'm not mistaken, that should give you about 4,000, whichever currency you have. But let's say I don't want to take my profit there. I want to hold on. Once price gets here, under no condition should you leave your stop loss behind anymore. Move your stop loss in front of your entry. So that way you do not lose any amount of money. And ideally you want to hide it somewhere at the top here, because if you move it too close, you'll get raided. And you'll be like, why didn't you hold on or leave your stop loss back? So I'll probably move my stop loss somewhere around here where all the wicks or the body of the candle ended. So when price pulls back, price is probably going to retest here or retest somewhere around the body of the candle, but not retest the top of the candle. So price will retest somewhere around here. So that would be ideally where my new stop loss would be. And I will still be in profit about 57 pips. I'm not losing anything. And that 57 pips should be, if I'm not mistaken, with a one lot should be about 500 and something for you to still hold anyway. So that's one way to approach it. Now, let's say if you're going for the long-term move that we already see that is most likely going to happen from, the seasonal. And so throughout the season, you can see price keeps coming back up. It's going to retest you. It's going to keep retesting and retesting you till it gets back to its destination that's going to. So you should be prepared for that. So it's not going to just go all the way down. No, it's going to come back up, go back down, come back up, retest you, go back down, come back. So you have to be ready for all of that move. This is the moves that could change your account for life. Once you get that first one that changed your account and you get into that momentum, you can write it down, write it back up, write it down, write it back up, and take it all the way through the year. And we can repeat the same thing next year until the loop cuts out. It happens a lot in gold, basically. So that's step one. So what we're going to do then is, if we are not going to take our profit right there, what we can do is this. We can go on, let's go back to the daily. The next point in daily, if I'm not mistaken, is right here. There's wicks right here. Now, this wicks right here signifies another potential take profit area. I will take my profit at least right here. Remember, there's the body of the candle, there's the wick of the candle, then there's one wick that's always in the middle somewhere. I go for that middle one. That middle one is what you want to go for. And look at it, that's the same level. Price stopped here, price stopped here, price stopped here. The answer is always kind of there in front of you. You just have to be able to look for it. So always go for that middle one and take your profit right here if you want to. But if you want to be brave enough and, want to hold on tight, I mean, it's all or nothing. You might profit the entire lapse, or you might just lose zero and not make any money at all. But either ways, you're still winning because you didn't lose any money. So if that's the case, you want to come out here, you can come out here, and that's 400 to 500 pips, almost 500 pips. Let's call it 480 pips. Okay, that's another one right there. Now, that's the take profit. Your stop loss has to be based on whatever you've had planned right here. And I mean, this shit kind of explains it. If you had a starting balance of 1,000, and you have 5 entry positions, let's say you have 1 entry position, and your maximum profit would be 50% maximum risk. So maximum risk is 10% of your total account, and your maximum profit in this case could be, say, 100% of your account. Then your profit target level will be 1,000 pips. Now, in this situation, we're not targeting that. So we targeted about 200 pips for the first take profit if you're the first person that wants to take your profit at 200 pips. So then with 200 pips, why is it giving me this? Did I miss something? Maximum, oh, no, 20%, not 200. Yeah. So your profit target is 200 pips or 200 pounds, whichever. And your SL value, actually, that is giving you right here is 8 if you're only risking 10%. So let me see, starting balance, entry position 1, maximum risk. Yeah, the entry size is too big. So basically, this is giving you an entry size of whatever it is, 1.2 lots. So with 1.2 lots, you're actually making this. So let me just increase the entry position to about 5 entry positions. I'm just going to break that down. So basically, I'm going to load up a calculator. You might have to use a little bit of calculator right here. And it's saying the target for pips is 15. So let's say, for example, this is 1.2 lots right here. So I'm going to say with 5, I want to have a stop loss of, let me divide that by 10, for example. So 0.12 would give me your stop loss value in this situation. Let's say you have 1 position right here, would give me, you have to times that by 10, basically. You have to times this by 10. Will give you about 83 pips stop loss. 83 pip stop loss, and in about you times that by 10, 160 pips, you should reach your target of 20%. I've definitely confused someone right here, right?
Mm-hmm.
Okay, let me explain again. So basically, I didn't put that in here, so it's something I have to do mentally. So let's say I had one position, one entry position. It's telling me that if I had 1.2 lots of entry size, then in 16 pips, I will have made 20% of my account. But your stop loss is 8 pips. Now, your stop loss being 8 pips means you have to get your target spot on. Your entry has to be spot on. But now, I don't want to have my entry spot on because in some cases you won't get it spot on. So let's say I want to risk more in terms of, I want to risk the same amount I want to risk in my account, but I want to still risk the same 10%, but I want my stop loss to increase. Now, if you want your stop loss to increase while risking 10% of your account, then your entry size will have to decrease, right? Is everybody still on the same page?
Yeah.
Yeah.
So your entry size has to decrease. Now, let's say we decrease our entry size by 10 times. So which is 1.2 divided by 10, which will give us 0.12. So our entry size will now be 0.12, while our stop loss would be 8.33 times 10, which is 80 pips or 83 pips. So now I can risk 83 pips with 0.12 entry and still make my maximum profit, 20 pips, but my target pips will go up by 10 as well, which gives me 160 pips. Does that make sense?
Yeah.
Okay. Is there anybody still confused? Okay, we good. So basically, in this situation, we can have an 80 something pip stop loss, but our take profit would have to be, our take profit mark will be longer. So if I have 80 some pip stop loss, my take profit will be 100 and something, 60 something pips, and that way I can stay in the trade longer. So rather than in this situation right here, I have to even go to a very low time frame, let's say about 5 minutes to illustrate what I'm saying.
That's like 100% profit.
Yeah. So in this situation, if we use what the sheet told us, it's only giving us 8 pips stop loss. So if you enter right now, within 8 pips, if price moves a little bit up here, you've lost. But if price comes right here, 16 right here, you've made a whole lot of profit, 20% of your profit. Now, what I'm trying to say is this. I would rather have this stop loss size right here, 83 pip stop loss right here. And my take profit will be somewhere down here. Because this gives me a leverage to move, okay? And that's how you have to start thinking. You have to have a wide stop loss because it's a long-term move and these swings will take place. This is what's happened in the average of years of 40 years, 15 and 5 years. There's always those swings, but the end result is gold is going to bottom out at one point. So you want to be able to have enough to stay in the trade so you don't get raided out of that trade whilst benefiting from all the profit from the trade. Okay, so let me go back to a higher time.
What I was saying when I mentioned, what I was saying when I said 100% profit, I mean, it's like a ratio 2-to-1.
Yes.
The stop loss 83 pips, the profit 163 or
Yes.
more.
Yes.
Yeah, so it's like a ratio 2-to-1. Stop, the loss is 1, then the profit that can be taken from it is 2.
Yeah, this is it. Maximum profit is 20%. Maximum risk is 10%.
Yeah,
So
yeah.
2-to-1, exactly 2-to-1 as you're speaking about. So basically, that's the way to approach the market now. It's not about making a huge amount of profit in a short time frame, but it's making consistent amount of profit or a profit that doesn't give you hypertension out of the way.
Agree.
Yeah, you don't want to get raided because a lot of people get raided in this trade. I mean, our first entry, if I can remember, my first entry was somewhere around here or here. I can't remember which one was it. Was here or here, one of the two.
Yeah, it was around there. Yeah,
Yeah.
174.
Yeah.
I saw it.
Yeah, so it was around somewhere at the top right here. And the way I found the entry is something that there was this thing I used to do when I was trading binary option. And let me just try to show you. Now, this is how I do it. I don't know if you guys are familiar with Trendline. You should be if you watch the videos. So now I do this 1, 2, 3. Once price touches the third time, price is most likely going to bounce up. And looking at this right here, once price open, if price doesn't make a gap, and if price maybe open somewhere around here, price is going to touch here, probably move back up, and probably move back somewhere here or maybe somewhere here before price breaks through. Okay, so now the 1, 2, 3 that I do is this. Because price touched here, price touched here, it hasn't touched here, I'm going to ignore this. Then I go to the next 1, 2, 3 right here. Now, a lot of people don't do it like this because this is just, it's weird. But I noticed it worked for binary and I still use it for Forex. So 1, 2, 3 means 1, 2, but it broke out right here. So I'm going to go to the next one right here and do 1, 2, 3. Now, this 1, 2, 3 right here is too far. It's too wide. So price hasn't got there yet. So it's not valid. And I go do the next 1, 2, 3. Now, from the next 1 to 3, 1, 2, you can see the next point of it didn't touch it right. I almost did, but it came back, touched right here, broke tiny bit out of it, then came back up. You understand? And that's the logic that I used when I was coming back down. So this is how I started. It must be the 2 highest point. So at this point, at this time, price was highest there. So I did 1, 2, 3. So 1, 2, my next entry will have been here, somewhere around this line. Now, it would have gone down a little bit. I would have locked myself in profit, got rated. Okay, no problem. I'll let that go. Then I would move to the next one right here. 1, 2, 3. 1, 2. The third one, my entry would be right here. Well, I've gone down a little bit and I would have locked myself in profit, got rated again. Cool, no problem. And my next one will be here. 1, 2. The third one is most likely going to be here. And look at the surprise right here. Looking at this, price might actually end up pulling back right here in the intersection right here of both. So price might end up coming back all the way 142 pips before actually bottoming out. Or if there's a gap, price might actually come in right here before there's a gap. The 1, 2, 3 rules. That's basically how I trade. Now, I had to go back to the basic because of coronavirus. And basically, that's what we're going to do. Oh, by the way, this is going to end now. I'm going to restart another one if you want to come in. So we can restart again if you want.
Okay.
Let me actually restart it ASAP. I'm coming. I'll
Okay.
restart it now.